Today, the rate cut dance begins, but you're not invited. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, to the surprise of no one, the Federal Reserve cut its benchmark interest rate on Wednesday, as signalled in my earlier post, and they went for the more aggressive half percentage point rise.
Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings.
The Federal Open Market Committee voted 11-1 to lower the federal funds rate to a range of 4.75 to 5% after holding it for more than a year at its highest level in 2 decades. It was the Fed's first rate cut in more than 4 years. Governor Michelle Bowman dissented in favour of a smaller quarter-point cut, the first dissent from a governor since 2005 and the first dissent from any member of the FOMC since 2022. Recall that the central bank raised rates 11 times, bringing its benchmark to a 2-decade high in July of 2023. Since then, inflation has cooled considerably and at 2.5% is nearing the Fed's 2% target. And while the labour market has weakened, there's no clear indication the US economy is in a recession or on the cusp of falling into one. Layoffs remain low, consumers are still spending, and the economic growth is strong. The press debrief was interesting in the context of the Federal Market Open Committee's deliberations, given their fixation on being data dependent on how inflation is travelling, while their renewed focus on the labour market when current data is pretty good in terms of job growth and unemployment suggests less data dependence and more taking out insurance in case a weaker jobs market emerges later. In the past, of course, such lifts in unemployment have often been quick, but it must be said there is an innate inconsistency on the inflation and employment side of their mandate. Until recently, officials put an emphasis on their quest to stifle inflation, but in their statement on Wednesday, policymakers indicated they now see the risks to employment and inflation as roughly balanced. The committee is strongly committed to supporting maximum employment, in addition to bringing inflation back to its goals, they said. The good old dot plot, where each member adds their rate projections and release following their 2-day meeting, showed a narrow majority, 10-19 officials, favouring lowering rates by at least an additional half a point over their 2 remaining 2024 meetings. 7 policymakers supported another quarter-point rate reduction this year, while 2 opposed any further moves. Powell cautioned against assuming the half-point move sets a pace that policymakers will continue. I do not think that anyone should look at this and say, oh, this is the new pace, Powell said. Policymakers also penciled in an additional percentage point of cuts in 2025. That's according to the median forecast. In their statement, policymakers said they will consider additional adjustments to rates based on incoming data, the evolving outlook, and the balance of risks. And they also noted that inflation remains somewhat elevated and jobs gains have slowed. Officials updated the quarterly economic forecasts, raising their medium projection for unemployment at the end of 2024 to 4.4% from 4% back in June. That would represent a small deterioration from the current level of 4.2%. Powell had said last month that further cooling in the labour market would be unwelcome. The median forecast for inflation at the end of 2024 declined to 2.3%, while the median projection for economic growth ticks down to 2%. Policymakers still don't see inflation returning to their 2% target until 2026. Officials again raised their projections for the long-run federal funds rate to 2.9% from 2.8%, and Powell added that he believes interest rates are unlikely to return to the ultra-low levels seen for many years before the pandemic. Wednesday's decision begins a new chapter for the Fed, which started lifting borrowing costs in early 2022 to curb a pandemic-driven surge in prices. Inflation, fanned by supply chain disruptions and a wave of demand from lockdown consumers, ultimately climbed higher. But of course, the truth is that the Fed themselves, through their quantitative easing programs and ultra-low rates, stoked inflation in the first place. So all up, the updated dot plot suggests a gradual path of rate cuts going forward, suggesting the Fed sees the 50 basis point move as a preemptive one that will be enough to stabilise the labour market. The median participants still see real GDP growing at a solid pace of 2% over the year. Markets were volatile, with the S&P 500 index wobbling, swinging between gains and losses after hitting an all-time high in the immediate aftermath of the Fed decision. Treasury two-year yields remain slightly lower than before the announcement, and investors are now betting on an additional 75 basis points of cuts by the end of the year. That's according to the futures. So, by the time the trading day ended, the gains fizzled as a more sobering economic and market reality sunk in. Even with the half-point rate cut, the kind of aggressive move normally reserved for a recession or crisis, and more on the way, the investment backdrop was actually no more clear-cut than it was before the announcement. But that begs the question, what is going on here? Well, Jerome Powell delivered exactly what traders up and down Wall Street had long hoped for, a big interest rate cut that would justify this year's steep rally in stocks and bonds as the era of tight monetary policy finally began to reverse. But excess savings that helped support Americans in recent years have run dry and delinquency rates are rising. An increase in job losses could trigger a pullback in spending and slow the economy. So below the hood, there are some growing signs of strain. Yet it's hard to read what is playing out. And the muddied economic picture has increased uncertainty and spurred divisions among Fed officials over the best path forward for policy. Some are anxious to curb labour market weakness before it spirals into more pain. Others worry that cutting rates too quickly might reignite demand and keep inflation elevated. Of particular concern to traders were comments from Powell that coincided with the reversal in the stock and bond markets, that nobody should expect the Fed to make a habit of half-point reductions in the future, and that the neutral level of interest rates is likely higher than it was before the pandemic. Actually, Powell was upbeat about the economy and waved off recession fears, tempering the market's expectations for where it's heading. During his press conference, he said that the central bank is confident strength in the labour market can be maintained in the context of moderate growth and inflation moving sustainably down to that 2% target. At the same time, he cautioned against assuming the half-point move set a pace that policymakers would continue, underscoring that everything would hinge on how the data came in. Finally, it's worth noting that the Fed said it would maintain the pace at which it's reducing bond holdings each month, letting excess liquidity continue to drain from the financial system. Powell also made clear that he believes the Fed can reduce the balance sheet, a process known as quantitative tightening, and lower rates at the same time. We're not thinking about stopping runoff because of this, he said. We know that these two things can happen side by side in the sense they both form part of normalization. The central bank has been winding down its holdings since June 2022. The impact of the first cut from the Fed echoed through global markets, but remember that the Fed shift lower to 4.75 to 5% probably won't impact the Bank of England's latest rate decision due today, which is most likely on hold following the cut they made last month. So far as Australia is concerned, the new Fed rates are still significantly higher than the RBA's weak 4.35%, and inflation in Australia is running much hotter as a result. The data flows in Australia also suggests no reason for the RBA to cut anytime soon, as for example the unemployment rate, which was steady at 4.2% in August. That's according to the latest data from the ABS. The number of unemployed people fell by around 10,000 people, while the number of employed people grew by around 47,000 in August. This resulted in the unemployment rate remaining steady at 4.2% and the participation rate remaining at its record high of 67.1%. The bulk of the growth was actually in part-time work, especially in the aged care and healthcare sectors, more government jobs, in other words. The growth in employment increased the employment to population ratio by 0.1 percentage points to 64.3%, which is just below the November 2023 high of 64.4%. This rise in the employment to population ratio was underpinned by an increase in the employment to population ratio for men, which rose 0.2% to 68.1%, while the measure stayed at the near historic high of 60.6% for women. The high employment to population ratio and participation rate shows that there are still large numbers of people entering the labour force and finding work as employers continue to look to fill a more than usual number of job vacancies. While the number of unemployed people fell slightly to 627,000 in August, it has risen by around 45,000 people since the end of 2023. Season-adjusted monthly hours worked rose by 0.4%, slightly stronger than the 0.3% rise in employment. The proportion of people working reduced hours because they were sick continues to be above pre-pandemic levels. However, the proportion of people working less hours than usual due to economic reasons, such as no work or less work available, is below pre-pandemic levels, which points to continued relative tightness in the labour market. The underemployment rate rose by 0.1 percentage points to 6.5%. However, it was still 0.1 percentage points lower than August 2023 and 2.2 percentage points lower than March 2020. The underutilization rate, which combines the unemployment and underemployment rates, was steady at 10.6%. This remains well below the 13.9% recorded in March 2020 before the COVID-19 pandemic. And there was another data point from the ABS today as well, which showed that Australia's population grew by 2.3% to 27.1 million people in March 2024. Our population at 31st of March 2024 was 27.1 million people, having grown by 615,300 people over the previous year. Net overseas migration drove 83% of this population growth, while births and deaths, known as natural increases, made up the other 17%. Annual net overseas migration for the year to March 2024 was 509,800 people, down from a peak of 559,900 people in September 2023, but still way over what is sustainable. Natural increases came to 105,500 people in the year ending March 2024, made up of 289,700 births and 184,200 deaths registered in Australia. Actually, Western Australia was the fastest growing population, up 3.1% in the 12 months ending March 2023. That was followed by Victoria, which grew by 2.7%, and Queensland, which grew at 2.5%, but Tasmania saw the lowest growth at just 0.4%. With the quarterly CPI still sitting at 3.8%, and the economy still overheating thanks to the high migration intake, there is nothing here to change the RBA's position, in my opinion. Markets, on the other hand, are still seeing cuts ahead, maybe even later this year. But as discussed before, they could well be wrong. Therefore, I don't think that the Fed's move based on a lower rate of inflation there has much relevance in the short term in Australia. Were it not for the massive flood of migrants and the job creation programs funded by state and federal governments, we would probably be in a recession and rate cuts would probably already be in play. But the brutal truth is, government policy is keeping rates higher for longer. And a final thought. CBA is currently valued somewhere between Google and Microsoft on a relative PE rating. But the future for our banks, while positive potentially on rate cuts and mortgage growth, misses the immense deflationary terms of trade shock coming out of China, most notably from iron ore, coals, and gas. Bank margins will get caught here, and valuations will ultimately return to more normal levels. Meantime, relative to international peers, Australian banks are, well, hilarious. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.